What if I told you that tomorrow morning your coffee could cost $1 billion? Not because Starbucks got greedy, but because the money in your wallet became worthless overnight. You'd call me crazy, right? Except it's already happened. Multiple times. In the last 100 years alone. Let me paint you a picture. Germany, 1923, a loaf of bread cost 200 billion marks. Not million, billion. People are literally pushing wheelbarrows full of cash just to buy groceries. And here's the terrifying part. By the time you wait in line for 15 minutes, the price has changed again. The currency is losing value faster than you can spend it. Venezuela, 2018. A carton of eggs will set you back 7 million bolivars. Zimbabwe, 2008. You need a $100 trillion bill just to catch a bus ride. Lebanon, 2023. The currency crashes 98% in 4 years, and doctors are driving Uber to survive. Here's what keeps me up at night, and what should keep you up too. The average lifespan of any government-backed currency is just 27 years. 27. The US dollar, as we know it, has been around since 1971 when we left the gold standard. That's over 50 years. We're living on borrowed time. So here's the real question. When the rules of money get rewritten overnight, what actually holds value? I spent months digging through economic disasters from Weimar Germany to modern-day Venezuela, Lebanon, and Zimbabwe. I'm talking historical data, not theories or predictions. And I found something fascinating. 5 assets that survived every single collapse, and 2 that went to absolute zero every time. By the end of this video, you'll know exactly what to hold when everything falls apart. Stay with me. Before we get into what survives, you need to understand how currency collapse actually works, because it's not random chaos. It follows the exact same 5-stage pattern every single time, like clockwork. Stage 1, the government spends more money than it collects in taxes. They're running a deficit, living beyond their means. Stage 2, instead of cutting spending or raising taxes, they just print more money. Problem solved. Right? Wrong. Stage 3. The currency starts losing purchasing power. Your money buys less and less each month. Stage 4. People panic and start fleeing to other assets, anything that's not the dying currency. And Stage 5. Complete collapse. Game over. This isn't theory. Look at Weimar Germany. In mid-1922, it took 320 marks to buy $1 US. 18 months later, in November 1923, it took 4.2 trillion marks to buy that same dollar. That's a 98% loss of value in a year and a half. Venezuela's bolivar went from 10 per dollar to over 1 million per dollar in just a decade. Lebanon's pound crashed from 1,500 per dollar to 89,000 in 4 years. Different countries, different time periods, identical patterns. So what actually holds value when this happens? Let me show you. The first asset is the most obvious one, and yet most people still don't own any of it. Precious metals, gold and silver, the assets that governments can't print and central banks can't manipulate out of thin air. Here's the brutal math that should wake you up. During the Weimar collapse in Germany, if you held paper marks, you lost everything. 100% wipeout. Your life savings evaporated. But if you held gold, you maintained your purchasing power completely. An ounce of gold bought you the same basket of goods before the collapse, during the collapse, and after the collapse. The currency around it changed. Gold stayed the same. This exact pattern repeated in Zimbabwe. When Mugabe's government started printing $100 trillion notes, anyone holding gold was protected. Same story in Venezuela. While the bolivar became worthless paper, gold retained its value. And we're watching this happen right now in Turkey. In late 2024, gold deposit accounts at Turkish banks surged from 1.36 trillion lira to 2.72 trillion lira in just 1 quarter. That's a doubling in 3 months. Why? Because Turkish citizens see the pattern forming. Runaway inflation, currency debasement, and they're running to the one asset that survived every collapse in human history. Here's what critics of gold completely miss. Gold doesn't need to do anything productive. It doesn't need to generate earnings or pay dividends. Its entire purpose is to not be debased. When governments print unlimited amounts of currency, the purchasing power of each unit collapses. Gold supply can't be arbitrarily expanded, so it becomes more valuable by default. Even during the 2008 financial crisis, gold initially crashed when liquidity froze up. But once the dust settled, it rose 166% in less than 3 years. Silver did even better at 448%. Back in the 1970s, during stagflation, gold fell almost 50% mid-decade, then bottomed out in 1976 and surged 440% over the next 3 years. The mechanism is simple. Precious metals are insurance against monetary system failure, not speculation. Insurance. You hold them because they preserve purchasing power when everything else burns. The second asset that survives is foreign hard currencies. When your domestic currency is dying, the escape valve is holding someone else's stable money. Let me take you to Beirut, October 2019. Imagine you're a nurse. You've worked hard for a decade and saved $50,000 in your bank account. The Lebanese pound has been pegged at 507 per dollar since 1997, rock solid for 22 years. You trust the system. Then the peg breaks. August 2019, the black market rate hits 1,600 pounds per dollar. April 2020, it's 3,000. March 2021, it's 14,000. By 2025, the official rate is 89,000 pounds per dollar. Your $50,000 in pound-denominated savings is now worth $1,000. You just lost 98% of your purchasing power while the number in your account stayed exactly the same. But here's the kicker. Your colleague, another nurse who worked just as hard, kept her savings in physical US dollars outside the banking system. She maintained 100% of her purchasing power, not because the dollar was magical. She could have used Swiss francs or euros, but because she held a currency that wasn't collapsing. This pattern repeats everywhere. In Zimbabwe, the economy dollarized itself before the government even made it official. People just abandoned the Zimbabwe dollar and started using US dollars for everything. Ecuador did the same in 2000 after their financial crisis. El Salvador in 2001. Panama has been dollarized since 1904. Venezuela right now, Venezuelans use dollars for major purchases, even though the bolivar is still technically legal tender. In Argentina, you buy property in dollars, not pesos. In Cambodia, ATMs dispense US dollars, not reals. This isn't a policy choice by governments. It's a survival mechanism by regular people. When domestic currency fails, rational people switch to stable foreign currency. The government can mandate whatever they want. People vote with their wallets. The lesson is crystal clear. Access to foreign currency during a crisis means complete protection. Someone holding dollars during the Lebanese collapse maintained their wealth. Someone holding pounds lost 98%. That's not market volatility. That's the difference between survival and financial annihilation. The third asset is counterintuitive, and it's what separates people who truly understand currency collapse from those who don't. Productive equities, stocks, ownership in real companies with real assets. Here's what blows people's minds. Venezuela's stock market rose over 400% in 2024. The Caracas Stock Exchange surged from 2,082 points to over 6,000 in just 9 trading days in January 2026. Individual stocks went absolutely parabolic. Mercantil Servicio Financiero up 200%, CanTV up 219%, Banesco Provincial up 171%. You might be thinking, wait, the economy is collapsing and stocks are skyrocketing. That makes no sense. Actually, it makes perfect sense once you understand what a stock really is. A stock isn't just a piece of paper or a number on a screen. It's ownership in real assets, factories, equipment, inventory, land. When the currency collapses, the nominal price of those assets rises to match inflation because the assets themselves haven't disappeared. Think about it this way. Imagine a Venezuelan manufacturing company worth $100 million in actual productive capacity. When the exchange rate goes from 10 bolivars per dollar to 30 bolivars per dollar, the stock price rises from 1 trillion bolivars to 3 trillion bolivars. Not because the company suddenly got more valuable in real terms, but because it takes more bolivars to equal the same dollar amount. But here's the critical distinction most people completely miss. Not all stocks survive equally. Only companies with revenue streams diversified away from the collapsing economy maintain real value. A company earning 100% of its revenue in bolivars sees its real profitability collapse even as its nominal stock price rises, because it has to convert worthless bolivars back to dollars to buy foreign materials and equipment. But a company that exports 50% of its production receives dollar revenues directly. Its bolivar costs decline in real terms while dollar revenues stay stable. Real profitability actually improves during devaluation. Research on the Latin American crisis of 1982, Mexico's peso crisis of 1994, and Asia's financial meltdown of 1998 confirms this. Companies that could redirect sales from local markets to export markets survived and thrived. Other investment forms plummeted into negative territory. The key was export capability. So the lesson here is clear. Productive equities with international revenue streams aren't just survivors of currency collapse, they're beneficiaries. But domestic-only companies burn right along with the currency. Quick pause here. If you're realizing that everything you thought you knew about protecting your wealth is completely wrong, smash that subscribe button. I break down financial disasters so you can see the patterns before they repeat. It's free knowledge in a system designed to keep you in the dark. Now let's get back to the assets that survive when money dies. The fourth asset is consumables and barter goods. When the formal monetary system fails completely, economic activity doesn't just stop, it reorganizes around different media of exchange. Post-World War II Germany is the perfect example. The Reichsmark was so worthless it was effectively abandoned. People started trading goods directly. Cigarettes, coal, potatoes. Cigarettes became especially prominent as a temporary currency. American soldiers would buy cigarettes from army stores for pennies and trade them with Germans for goods and services worth exponentially more. Why cigarettes? Think about it. They came in standardized packs. They were easily divisible, non-perishable, lightweight, and widely accepted. They had all the properties of money except one. The government didn't issue them. Black markets near train stations in major German cities operated 24/7, trading everything from train tickets to forged documents with cigarettes as the medium of exchange. Here's the fascinating part. When large shipments of Red Cross packages arrived at POW camps, sometimes injecting hundreds of thousands of cigarettes into the camp's money supply all at once, it caused inflation in cigarette prices, same exact mechanism as when governments print fiat currency. More cigarettes chasing the same goods equals higher cigarette prices. Fast forward to Venezuela 2018. As the believer became worthless, Venezuelans started bartering. Fishermen traded their catch for flour just to feed their kids. The items that held value were medical supplies, food, water, fuel, batteries, lighter fluid, basic tools, anything with immediate consumption value or that enabled essential functions. During supply chain disruptions, even toilet paper, soap, and wet wipes became incredibly valuable, not for comfort, but for health. Staying clean prevented infection spread during systemic failure. But here's the limitation with consumables. They get consumed. They can't serve as long-term stores of value. You can't build a portfolio on aspirin and batteries. They're tactical, not strategic. The optimal approach is keeping a small portion in physical necessities for immediate exchange value during acute crisis phases, but keeping the bulk of your wealth in assets that don't evaporate when you use them. The fifth and final asset is agricultural land, the immobile store of value that produces the one thing humans absolutely cannot live without: food. During the Great Depression, farmers had survival advantages over urban dwellers that were stark and undeniable. Farm families grew gardens, canned fruit from their orchards, had milk and cream from dairy cows, raised chickens for meat and eggs. They could do without new clothing and consumer goods, but they faced one brutal constraint. They still had to pay property taxes and debts to banks in cash. This same dynamic plays out in every modern collapse. In Venezuela, people who owned agricultural land maintained the capacity to produce food regardless of currency fluctuations. People who owned urban commercial real estate faced tenants who couldn't pay rent in any meaningful terms. Land produces calories. Urban real estate produces rent denominated in a collapsing currency. Calories win every time. But, and this is critical, agricultural land has severe vulnerabilities you need to understand. First, it's completely illiquid. You cannot move it. You cannot quickly sell it. If political circumstances deteriorate and ownership becomes unsafe, you're stuck. Zimbabwe, year 2000. Mugabe's land seizure program simply revoked commercial farmers' property rights by government decree. Farms were redistributed without any compensation. Sophisticated agricultural operations were destroyed. Agricultural output collapsed 60% over a decade. The aggregate value of farms declined by 75% between 2000 and 2001 alone. Second vulnerability is taxation. Someone holding urban commercial real estate in a collapsing currency may be forced to sell at a fraction of its previous value just to raise cash for property taxes. Land cannot hide. Governments know exactly where it is, and they can tax it into oblivion. Third point, agricultural land that produces export crops is vastly superior to land producing only for domestic consumption. Export crops sell for stable currency. Domestic crops sell for collapsing local currency. So the strategy is to own land that's either productive and capable of generating export revenue, located outside the jurisdiction of the collapsing currency, or held through a corporate structure that protects against seizure or direct taxation. Agricultural land maintains fundamental value through its capacity to produce food, but it's less liquid and more vulnerable to government interference than precious metals or portable equities. Now let's talk about what goes to absolute zero, because understanding what fails is just as important as knowing what survives. Number one with a bullet, fixed income securities denominated in the collapsing currency, bonds, treasury notes, anything where you're essentially a creditor to a failing state. Weimar Germany. Bondholders who held government bonds and marks watched their investments become completely worthless as the marks used to pay interest and principal evaporated. Argentina, 2001. Bondholders saw their nominal value cut by 70% in debt restructuring. Even this reduced value could only be collected after years of brutal legal disputes. The fundamental problem is this: fixed income securities are a claim against the collapsing currency itself. When the currency collapses, the claim becomes worthless. This isn't market failure. This is logical consequence. Number two, savings accounts in domestic currency held within failing banking systems. Lebanese deposits denominated in pounds lost more than 95% of their value as the pound devalued from 3,500 per dollar to 89,000 per dollar by 2025. Bank customers who placed their life savings in pound deposits in 2019 retained just 2% of their original purchasing power by 2024. The nominal amount in their account stayed the same. The value disappeared into thin air. History is completely unambiguous on this. Being a creditor to a failing state is the fastest route to 100% wealth destruction. So where are we seeing these warning signs right now? Because pattern recognition only matters if you can spot the setup before it executes. Iraq, financial crisis due to lack of cash liquidity. More than 70% of the monetary supply has vanished due to banking restrictions on withdrawals. The dinar devalued from 190 per dollar to unofficial rates approaching 1,750. There's public distrust of banks and currency smuggling across borders. This is stage 3 behavior. Turkey, gold deposit accounts more than doubled in a single quarter as citizens fled to precious metals. Runaway inflation and currency debasement. This is stage 4 behavior. Currency substitution has already begun. Lebanon, 98% currency collapse already fully executed. The banking system is technically insolvent. This is stage 5, complete failure. And then there's the elephant in the room, the United States. $38 trillion worth of national debt. Debt to GDP ratio expanding unsustainably. Interest payments on the national debt are now higher than military spending. The dollar's share of global foreign exchange reserves has fallen from 80% in the mid-1970s to 65% today. This is the exact same path that British sterling traveled during its decline as the world's reserve currency. In 1913, Britain was the world's biggest creditor nation. Within 40 years, it became a net debtor, and the dollar replaced sterling as the global reserve currency. The pattern is visible if you're willing to look at it honestly. So here's the brutal truth nobody wants to hear. Currency collapse isn't some hypothetical future scenario. It's the historical norm. The average fiat currency lasts just 27 years. 99% of all currencies that have ever existed no longer exist today. The question isn't if your currency will fail. The question is whether you'll have positioned yourself to survive when it does. Let me recap the 5 assets that survived every collapse since 1923. 1. Precious metals like gold and silver, the universal store of value that governments can't print. 2. Foreign hard currencies, the escape valve when your domestic money dies. 3. Productive equities with export revenue, not just survivors but actual beneficiaries of currency devaluation. 4. Consumables and barter goods, tactical liquidity when formal systems freeze. 5. Agricultural land, the calorie generator that produces the one thing humans can't live without. And the 2 assets that went to absolute zero every single time. 1. Fixed income securities in domestic currency. When the currency dies, so does your bond. 2. Savings accounts in collapsing currency, watching your purchasing power get annihilated while your account balance stays the same. The lesson here isn't to abandon all domestic assets and become some doomsday prepper hoarding gold bars in a bunker. The lesson is that genuine diversification requires holding different forms of value that respond differently to monetary system failure. A portfolio consisting entirely of stocks in a single country faces catastrophic risk if that country experiences currency collapse. A portfolio consisting entirely of bonds denominated in a collapsing currency will be utterly destroyed. A genuinely diversified portfolio includes exposure to precious metals as insurance, foreign currency assets to protect against currency-specific risk, productive equities with international revenue streams, and possibly real assets in stable jurisdictions outside your home country. The warning signs we're seeing right now in Iraq, Turkey, and Lebanon prove that currency crises remain a very real possibility. The US dollar is stable today, but the historical record provides overwhelming evidence that this status cannot be taken for granted indefinitely. The most prudent approach isn't to panic, it's to recognize the pattern and position yourself accordingly. Sufficient diversification across different asset classes and different jurisdictions means that no single failure scenario can destroy your purchasing power entirely. History has all the answers. You just have to be willing to look at the autopsies before you become the next case study. If this analysis gave you a completely new way of thinking about economic risk, hit that subscribe button. Drop a helicopter emoji in the comments if you're already positioning yourself for what's coming. I read every single one. And remember, the pattern is mathematical and predictable. The only question is whether you'll see it coming or whether you'll be standing in line at the bakery one day wondering how bread costs $200 billion. Thanks for watching. Now go diversify before you're forced to.